12.8 million barrels of oil have vanished from the global market. The global supply chain is paralyzed, and the Federal Reserve is about to play a dangerous game with $2 trillion that could freeze the financial system overnight. Here is the Q2 2026 intelligence they aren't telling you. Welcome to The Explainer. Today, we're mapping out a massive phenomenon that institutional analysts are calling the Domino Convergence. And let me tell you, it's tearing through the 2026 global economy right as we speak. We are looking at a really rare historical moment where a massive energy shock, an artificial intelligence supercycle, and a radical shift in monetary policy are all colliding at the exact same time. It's basically a perfect storm. Normally, the global financial system can absorb one of these shocks, right? It might even handle two if they're staggered over a couple of years. But right now, we have three distinct massive forces feeding into each other, creating this highly volatile feedback loop that standard financial models simply were not built to handle. So, to understand where the world is heading over the next few quarters, we really have to look at how these dominoes are falling. And we're going to start with the very foundation of global energy. This briefing is derived from institutional macrointelligence. This is not financial advice. Capital allocation involves severe risk. Consult a registered fiduciary. Section 1. The Hormuz oil shock. Okay, let's dive into this by starting with the physical catalyst that set this entire crisis into motion, the Persian Gulf. So, the global oil supply has plummeted to a multi-year low. According to the data, 12.8 million barrels per day have just simply evaporated from the global market since February 2026. To put that into perspective for you, that's the equivalent of completely wiping out the entire daily oil production of Saudi Arabia overnight. Just gone. It's a staggering 12% contraction from just weeks prior. Oil is literally the lifeblood of the global economy, so when a contraction this severe happens, it doesn't just mean paying more at the gas pump, it means agriculture, manufacturing, and global shipping are all facing an immediate paralyzing squeeze. And this brilliantly illustrates the massive chasm opening up right now between supply and demand. We're looking at International Energy Agency data showing 14.4 million barrels of Gulf output completely shut in, just offline. To compensate for this sudden catastrophic loss, the world has been forced into a record-breaking 246 million barrel drawdown of inventories. The global safety net is vanishing, and it's vanishing fast. We're eating into our emergency reserves at a pace that we absolutely cannot sustain for much longer without forcing some major industrial shutdowns. The reason so much oil is trapped actually sounds like something out of a movie. It's a totally unprecedented extortion regime happening right in the Strait of Hormuz. The passage is functionally closed to normal traffic because the IRGC is now charging a $2 million transit fee per vessel just to navigate the choke point. No way, right? But it's true, and it has completely upended international maritime trade. Look, when shipping companies get hit with a $2 million toll, their profit margins instantly vanish. They're forced to either halt operations entirely or pass those catastrophic costs straight down to the consumer, which acts as a massive driver for global inflation. Section 2. Global Macroeconomic Divergence. So how is the world reacting to this kind of historic energy shock? Well, it's creating a massive structural divergence between major economies. What we're seeing is a really stark contrast in economic survival. On one side, Europe is just suffocating under a fast energy pass-through. Because they rely so heavily on imported energy, they're caught in a stagflation trap set by the European Central Bank. Economic growth has completely stalled out, but everyday prices still rising. On the flip side, the U.S. economy is experiencing what institutional analysts are calling a temporary sugar high, this strange resilience that's masking the underlying global chaos. When major economies diverge this sharply, it breaks currency pairs and completely upends global trade balances. Let's anchor ourselves in the institutional data for a second. The IMF is projecting resilient U.S. growth at 2.4%, while Goldman Sachs pushes that even higher to 2.8%. Now, it's incredibly unusual to see this level of projected growth during a severe energy crisis, but they're pointing to immense tech investments and a massive domestic fiscal shield as the primary drivers keeping the U.S. afloat, even while the rest of the world is struggling just to keep the lights on. The mechanics behind that massive fiscal shield come from the One Big Beautiful Bill Act, or OBBBA. This is a $5 trillion fiscal policy that injected up to $191 billion in tax refunds right at the start of 2026. Basically, it translates to an average $2,300 to $3,800 individual tax cut. This huge liquidity injection is putting actual hard cash into people's pockets, actively buffering the U.S. consumer against the inflation caused by that oil shock. For the average household, getting a sudden check for almost $4,000 acts as a real psychological and physical buffer against $5 a gallon gas, at least for a little while anyway. Section 3, the AI Supercycle Shield. But, fiscal policy isn't the only thing keeping the U.S. out of a recession right now. Let's look at the second protective shield, the structural AI investment cycle. Now, what's really interesting about this is the sheer velocity of the capital involved. We're looking at the big 5 hyperscalers, the tech giants that are actively building out the infrastructure for artificial intelligence. Their capital expenditure jumped from $450 billion in 2025 to an absolutely explosive $805 billion in 2026. This spending is non-cyclical. These companies are in an all-out technological arms race, so they are spending this money regardless of what oil prices or interest rates are doing. By doing that, they're effectively forcing $805 billion of pure growth directly into the U.S. market. However, as Morgan Stanley warns, this Capex overconsumption environment masks a severe K-shaped reality in the market. Sure, AI data center power demand has hit an incredible 45 gigawatts, and semiconductor firms are seeing record revenues. That's the upward slope of the K. Everyone's happy. But on the downward slope, legacy software and IT consulting are collapsing, and the broader consumer base is still suffocating under everyday inflation. It's a highly polarized economy where your experience right now depends entirely on what industry you happen to work in. Section 4, Warsh, the Fed, and Repo risk. Let's move to our next piece of the puzzle and see how this builds into the absolute most dangerous systemic domino on the board, the regime change at the Federal Reserve. Right now, institutional models are closely tracking the transition to an incoming Kevin Warsh-led Fed. Warsh brings a philosophy focused on aggressively draining the Fed's $6.3 trillion balance sheet. He wants to reverse quantitative easing and violently return the central bank to a scarce reserves regime. Essentially, he wants to pull the punch bowl away from the market much, much faster than anyone is prepared for. So the absolutely crucial point here is understanding a mechanical tipping point known as the 10% repo risk constraint. This is the ultimate safety threshold for banking reserves relative to GDP. You see, the repo market is the underlying plumbing of the entire global financial system. If reserves drop below this 10% level because the Fed drains the balance sheet too fast, the system just lacks the basic liquidity to function. This threatens an overnight lending freeze, meaning banks literally stop trusting each other enough to lend money. And when that plumbing clogs up, the real economy halts. And that brings us straight to the institutional bear scenario. It starts with the Warsh Fed actively liquidating $2 trillion in mortgage-backed securities. This aggressively drains banking reserves, colliding right into the Treasury's heavy short-term debt issuance. That massive collision causes us to violently breach that 10% safety threshold we just talked about, triggering an overnight repo market freeze and forcing rapid panic selling across global markets as institutions scramble for cash that simply isn't there anymore. If you want to front-run the institutional capital shifts triggered by these geopolitical blind spots, hit subscribe right now before the algorithm buries this data. Section 5, Surviving the Fractal Crisis. So the logical question now is, how are institutional capital models actually planning to survive this convergence of extreme risks? Well, the models show us exactly why the traditional 60-40 portfolio is completely exposed right now. The standard mix of stocks and bonds that most retirement accounts rely on is totally failing to provide adequate protection against this specific three-front war. The war shock threatens Treasury yields with an aggressive balance sheet reduction. Meanwhile, a looming repo freeze risks instantly erasing the S&P 500's massive AI premium. And any further escalation over in Hormuz threatens to push oil to $200 a barrel, which would spark runaway inflation all over again. The big institutional pivot we're seeing is toward a strategy known as hard liquidity. This involves front-running that massive 45-gigawatt AI power demand by accumulating physical copper, literally the wiring required to build the new economy. At the exact same time, institutions are shielding their fiat exposure with precious metals, tracking towards a $4,700 price target for gold. It's all about owning physical, unavoidable assets that simply cannot be printed or frozen by a central bank. So how do you survive the Warsh Fed and the Hormuz shock? You abandon the 60-40 portfolio. The secret is hard liquidity, front-running the AI power grid through physical copper, and shielding your fiat exposure with precious metals before the repo market cracks. To understand exactly how the Fed's stealth QE operates, click the video on your screen right now breaking down the 2026 repo crisis.